Welcome to today's webinar. I have here with me Don Wenner. He is the founder and CEO of DLP Capital. This is a private real estate investment and financial services company that is focused on making an impact, not just for the investors, but also for the developers and for the people who will be renting what is being built, what is being acquired by DLP's investors. He's focused on affordable workforce housing and the difference it can make in people's lives, which I think is extremely commendable because I don't hear that focus from most real estate investors. They're not passionate about providing housing. They are, focused much more on the numbers, which is important as well, right? As investors, we all care about the returns we make and how much risk we take on. But I love seeing somebody passionate about the core business as well. And I've always been impressed with you, Don, by that. So it's wonderful to have you here for this webinar tonight.
Awesome. Well, thank you, Jim, for that very kind introduction. It's an honor to be here and excited to share a bit about what we're up to in that regard.
Awesome. Well, what we're going to do tonight is Don has a presentation. He's going to be talking a little bit about DLP Capital, what they do, who he is, why this is important, as well as what opportunities are available to you to invest through DLP Capital. After that presentation, we're going to be doing a bunch of Q&A, a bunch of answers to questions commonly asked. And I'll be presenting those to Don and putting him on the spot, having him answer all these questions that you and others have about DLP Capital. So, Don, I'm going to turn the time over to you and let you present.
Awesome. Thank you, Jim. I'm going to go ahead and get the screen up here right now. So thank you so much again for having me on here today. I'm going to walk through and share some of the updates and things that we're focused on here today, some outlook on what's going on in this wild world of real estate today, and then certainly cover the available investment funds that we have open to investors right here today. Before I kind of get into the presentation here fully, I'm going to start off and frame up some questions, and I'm going to ask these questions, and I just can ask all of our anybody listening here, watching, to kind of think of the answer, what you think this question is, and then I'm going to go ahead here and show the answers. And I just want to frame up a bit of what's going on in the real estate market today, in our world specifically of investing in workforce housing, and you might learn some interesting facts that might surprise you here a bit. So my first question here is, how much has rent increased throughout the Sun Belt region in the past year? And I did this at another live event we held here in St. Augustine recently, and I had answers all over the range from 3% up to somebody I think guessed 50%. And on average, rents have gone up 19% in the past 1 year, in the past 12 months. That means if somebody's rent was $1,500 a year ago, today on average it would be nearly $1,800. 19% increase in the past 1 year alone. One of the big drivers to that increase in rents is this. It plays into this next question: how many housing units or homes, for short, rental homes, but meaning both apartments and single-family homes, are we short in America today to keep up with today's current needs? And that answer is estimated at 5.24 million housing units short. And even though in a lot of places like where I live in St. Augustine, Florida, which is one of the fastest growing places in America, it seems like there's so many housing units being built. But the reality is the deficit is actually growing month over month still, despite a really great increase in construction since COVID began. But we're still short over 5 million housing units. Or in other words, we have the greatest undersupply of housing in America ever. And in the Sun Belt region, many of the markets that we invest in have an even more dramatic shortfall. Places where people are moving to heavily have an even greater supply issue in most cases. So rents have gone up 19%. We've had are short 5 million housing units in America, so have an incredible supply and demand mismatch. So how much have incomes increased in the last year? It would be great for Americans if that answer was also 19% to match the increase in cost of housing. But it is not, which is probably not a surprise to everybody. But they have gone up about 9%. And even though that still means for most people their cost of housing is outpacing their wages, and they are likely in a situation where, or many people are in a situation where their cost burden, too much of their income is going towards their cost of housing. The fact that we've seen a 9% on average increase in wages this past year is actually really, really promising. From 2010 to 2020 in America, we had about a 70% increase in the cost of living, the cost of housing in America, 70% over 10 years. And over that same 10 years, we had less than a 10% increase in wages. So we've had about the amount of wage increase this past year that we had for an entire decade. So that means people do have more incomes, that we're moving in a really positive direction there, which is really critical in order for people to be able to afford the increase in cost of housing. So it's a good positive for it. For those such as myself who have a lot of team members or employees that might not feel like a great thing that wages are going up so much, but for the overall economy and for us as owners of housing, it is a really good thing. So this is a little bit of a softball here for me, Jim. But how many months, quarters, years has DLP missed our return targets? Never. We've never missed a return target, so no losses, and we've never missed our targeted return in any month or period in any of our funds since we started managing funds about 10 years ago. Last month, the biggest side of our business from a fund standpoint is the lending side of our business, where we lend money to other real estate developers, builders, operators. We've been running our main lending fund now for 8 years. And last month, we had an annualized return of 12.89%, which was the highest return we've had in nearly 4 years. So that was pretty exciting. This month's shaping up very similar to last month. So a little bit of info, kind of some stats on what's going on in the market, what's going on here at DLP. A little bit of insight on why you should be interested in listening to the rest of what I'm going to cover here, and why you should be interested in DLP as a manager. First, I've said it already here, we've got a track record of exceeding our return targets in every period with no losses ever. And we put our investors first. So we pay our investors a preferred return, meaning you earn a return depending on the fund of 6 to 9%. Before we get any return, including before we even earn our management fee. And if you went and looked at 100 different fund managers, my guess is you would not find one other fund manager out of 100 that pays the investors returns before they get their management fee.
I haven't found one yet. I keep looking, Don, but I havenn't found one.
And I'm sure
I'm hoping it catches on, but it doesn't seem to be.
It hasn't caught on yet, but it's why we just think we want to put our investors first and make sure we're, even in volatile times, making sure investors are hitting their return targets. And this is a cool stat we think is important. So this is my personal belief. When I started 10 plus years ago in managing funds and started the company 16 plus years ago, when I first started presenting what we do to investors, and I showed that we invest in the Sun Belt and the Southeast and workforce housing, people thought, why would you do that? That sounds so risky. That sounds so terrible. I'd much rather invest in office buildings in New Jersey, right? And I'm saying that half joking, but that was often what I heard from people. And I don't want to invest in apartments. That wasn't thought of as a great investment. It seemed risky, right? Those of you listening, I'm making an assumption, I probably don't need to convince you that investing in workforce housing or investing in housing is a good place to be. Most people believe that to be the case today. But just like any other asset class, what matters, especially when things get hard, especially when there's volatility, what matters is who is managing that investment. And I believe in every asset class, in every industry, in every organization, in every sort of business line, in a recessionary time, in tough times, the best managers are going to pick up market share. They're going to grow. They're going to do really well, even when lots of other companies are struggling. And as we've grown, we've grown our organization by 60% or more every year for 16 straight years in revenue growth. And we're winning all these awards for our growth and so forth. We want to make sure as we grow that we become stronger as a manager, that we're building a really strong organization that can weather, any storms, any challenges, any issues that come about. And we started measuring that in something we call productivity per person, which is how much net revenue we generate per person at DLP. And even as we grow the organization, measuring how productive are we, how profitable are we per person. And last year, we increased our profitability or our productivity per person by 72% last year alone, while we added about 100 new team members. So we're building a strong foundation that's going to put us in a good position to deal with the challenges ahead. Part of that building a strong foundation has led to us being on the Inc. 5000 list, the fastest growing companies in America list. Making that list is something few companies do, obviously only 5,000, but very few companies make that list every year, year after year. In fact, last year was our 9th straight year. This year, a report comes out in a couple months, will be our 10th straight year as one of the 5,000 fastest growing companies in America. Last year, we were the 4th fastest growing company in America in all industries, in all companies that have made this list 5 times or more ever. We've now done it 9, about to be 10 straight years. So we've generated great consistency in how we grow and build our company, which is what's also led to the great consistency to the returns we generate to our investors. And this is maybe the coolest kind of question to kick off here of all, at least for me, is how many lives have we impacted at DLP, something we track every day towards our big, hairy, audacious goal, which is 641,000 lives. Which takes us to what is our big, hairy, audacious goal? What's the big goal all of our team members are marching on and what we want our investors to help us be a part of, which is becoming a Fortune 500 company through the impacting of 10 million lives. And that's important because I often hear from investors, well, Don, you're having all the success, all this money coming in. Why are you still taking more capital? Why are you doing this webinar here? Because we're still, even though we're 16 years into our journey, we're at 641,000 lives towards our goal of 10 million. So we've still got quite a bit of work to do. We need more support, more investors to be able to pick up the pace of being able to impact the lives of our residents, the lives of our investors, the lives of the developers, builders, operators we support and lend to, and the lives of the team members who commit their careers to working with us here at DLP towards the causes that we're focused on. Speaking of those causes, we have 4 crises we're focused on impacting here at DLP. Jim already hit on the most obvious one, the biggest one, which is the housing affordability crisis. We're also focused on what we call the happiness crisis, the jobs or workforce crisis, and what we call the wealth legacy crisis, which is the shirt sleeves to shirt sleeves and 3 generations crisis, which is that most of us as first generation wealth creators will have our wealth lost by the second, if not our 3rd generation. Doesn't need to be that way. And through appropriate education, you can avoid that more times than not. All right. So a quick bit about me for those who have never had the pleasure of meeting or you've never heard of us before. I am first and foremost a father, a husband, as well as the CEO of DLP Capital and the founder and the author of a book called Building an Elite Organization. The blueprint to scaling a high growth, high profit business. Been married to my wonderful wife, Carla. You see on the left there, 11 years. I have 3 sons, Donnie, Alex, and Jake, who's now 8 months old. He was a few weeks old in that picture when we adopted him at 9 days old this past September. We live in St. Augustine, Florida, but we also spend a lot of the hotter time in Asheville, North Carolina, where I'm actually heading as soon as we finish up this webinar here today. Over my 16 years of leading DLP, we've grown to $3 billion in assets under management. We've done over $8 billion in transactions. We'll do around $4 billion this year alone as we continue to scale. These are some of the awards and recognition we've received for growth and for building a great workforce and taking care of our people. This is where we operate. St. Augustine, Florida is where I'm talking to you from right now. It's our headquarters here. As of today, our Pennsylvania Northeast headquarters, where we started the company, is in the middle. But in about 3 weeks, we moved to this building on the right, which we're really excited about in Pennsylvania. And then we have hub offices in Asheville, in Orlando, and in Daytona Beach, Florida. coming soon to Denver, to Houston, and Dallas are some new places we're launching some regional offices in right now. Here's some of our numbers today as an organization. We have over 2,100 investors, including many of this awesome white coat community, part of our 2,100 investors here at DLP, over $3 billion. And I do want to say thank you to you, Jim, here briefly. I believe we have about 500 of those 2,100 members are part of white coat. So a pretty big part of our investor family. And have right now, we're investing over 25,000 units, rental homes, providing housing to more than 60,000 people today. Even though we do a lot of things at DLP, we're a vertically integrated organization doing all the underlying parts of our investment strategy. Our business model is relatively straightforward, relatively simple in terms of what drives what we do. So for us, this is what we call our flywheel. It's a term we took from Jim Collins. And for us at DLP, everything starts with capital being invested in our funds. We focus on building legacies, families, and wealth for faith-centered wealth creators. It certainly doesn't apply to every person who's invested with us, but most of our investor base we find to be spiritual, faith-centered, often first-generation wealth creators, if not first generation, still focused on building and creating wealth, who choose to invest in our funds. And then what we do with the capital you choose to invest with us is we go out and we invest in housing. We do that, as you'll see, across our funds in a number of ways. We do so as a lender. We do so as a partner to other developers. We do so directly as a developer. We invest in existing housing. We invest in brand new housing, but it's all housing. And it's almost all workforce housing. And then our secret sauce to what we do is we build elite organizations. We help build disciplined organizations who execute at a high level. That's what my book is about. And that's what we teach to the developers and builders that we lend to and partner with. And if we do these three things right, we create prosperity for our residents, our team members, you, our investors, and our operators. If we do that well, you continue to refer your friends and family and invest more money with us, and we get to keep picking up pace of this flywheel. These are our 10 core values that drive who we are, what we do, the type of people we hire, and how we make our decisions. One of the most important ones for you as an investor or potential investor with us certainly is stewardship, which is at the center of what we do here at DLP. These are our senior leaders responsible for driving and leading our team of over 300 team members here at DLP, focused on executing and making an impact across these four crises I already referenced here earlier. We have self-mandated that our funds are impact funds. We've self-mandated that over 80% of our investments are investments into workforce housing that is and will remain affordable for the local workforce, while focusing on creating jobs, positively impacting the happiness crisis and this wealth crisis, which if we had more time, I'd explain in a lot more detail. So one of the things we like to say here, and we're focused on doing every day, is we're doing well while doing good, which is what we believe impact investing is all about. Here's some of our recent successes. The building I showed you here in St. Augustine, we've been here for almost a year now, but we did tons of renovations and did a big grand opening a few weeks ago. Just last week, we were named the 191st fastest growing company in the Americas, not just North America, a third largest company, eighth fastest growing in all of financial services. We grew 76% last year alone. So those who don't know me, this might not be as important, but I mentioned earlier about the amazing opportunity I had to adopt baby Jacob in September. And these are some updated pictures as we get these requests from our investor base quite often. Speaking of people, some of the cool things and amazing people we have at DLP, our accounting team has done some pretty awesome stuff. We got all of our K1s, all of our tax returns out by deadline, no extensions. And you can see some of the stats, the amount of work that accounting team of about 25 accountants did and do every day is pretty awesome. We've added some new team members to continue to provide the best service to our investors. And one of the really cool things is we've added a number of new team members, and they all came from different parts of DLP, people who've already been proven, and we brought them into this team to service our growing group of investors, including two directors, two leaders, Lee and Liz. In addition, we brought on 5 success managers, we call them, and relationship managers to serve our investors all also coming from other roles in the organizations. So pretty excited about that. We've basically doubled our investor relations teams here in the last 60 days to make sure we continue to provide the level of service that our investors have come to expect. Speaking of our investors, and Jim, I don't know if my team had prepped for this, so I don't know if you'll be able to play this video, but I will go ahead and try and make sure you can hear the audio.
It wasn't all about finance. It wasn't all about what are we doing with your money, or I didn't feel like I came here and was pitched to purchase anything. I felt like we showed up and it was like, what can we do for you? What can we do to make you a better person at home for your family? What can we do to make you more successful at work? So that was my first takeaway, where I was just so surprised.
The support and the nurturing in terms of anything that I need, in terms of anything with wealth building, as far as CPAs and trust funds and all the pieces that help us to sustain wealth are there. In addition, we also spend a lot of time thinking about family, thinking about how our kids, how our grandkids will be able to sustain what we've worked so hard to create. So it's really a tremendous experience and opportunity. I'm super grateful.
It's about the community of the investors, how they can not only improve the lives of the people living in the communities that they're building, but the investors, the investing community also.
There are people that they're experienced, they've written books, they're passionate about what they believe, and I got a front row seat to hear things that are very relevant to my own personal life.
We've made some amazing friends in less than 4 days. We are definitely leaving here with people from across the entire country that otherwise we would not have had a relationship with, and that's within 4 days. And again, none of which you expect to take away from a 4-day finance retreat or investment retreat. So that, I think, is probably my favorite part.
That's a little video that was done after a big event.
It wasn't all about finance. It wasn't all about
that we did right after a big event in March in Ponte Vedra. Jim, soon after your big event. Ours wasn't quite as big as yours, but focused on we call our prosperity members, helping people live and leave a legacy and make a difference across on these 4 crises and make an impact. And that's a free benefit we provide to the White Coat community to be a part of the prosperity membership and focus on avoiding that church leaves in 3 generations and building great relationships and so forth. So, which we certainly can chat more about maybe in Q&A. But I'm going to move forward here to my last couple of things, get into the investments themselves, and then turn it to questions here, Jim. So some of the other updates of what we've had happen recently, we bought a number of new properties. We've been very active in Houston, Texas, for a number of really great reasons. These are some of the 2 of the recent acquisitions we did with a partner called Colony Hills Capital. We also bought this property in Houston called DLP Proper. We bought directly as sponsor, which is a student housing property that we're opening up to rent to not just students, to all or any local residents. We bought a similar investment to that in Tuscaloosa called Grand at Rum Creek here this past quarter. And then one more Houston acquisition called now DLP at Memorial, really beautiful community right near downtown in Houston as well. This is that event I referenced earlier in that video where we had some amazing speakers and had a great time. We had many members of White Coat come and join us for this fun event. And then, as mentioned earlier, we had this developer event here recently as well in St. Simons Island, Georgia, where we brought in a lot of our borrowers and developers and those we lend to and invest with. We brought them all together for 2 days, focusing on development, how we can get better together and learn from each other through this time of change and volatility and increasing construction costs and continue to grow our business and generate profits for our investors and create new affordable housing. One of the cool things I want to hit on here briefly that I want to thank a number of people, if you're listening, who are part of this. When we did this event in March in St. Simons, one of the speakers who was supposed to come talk to us was a real estate developer. Her name's Brittany, and she couldn't make it to our event live to be one of our speakers because she was on her way to Ukraine. And she runs an organization called Aerial Recovery, which they focus on coming in generally after natural disasters and basically saving kids from going into trafficking and so forth. Pretty amazing organization she runs. And they've been putting a lot of that focus around Ukraine. And I learned at this event, this was unexpected. This wasn't what she zoomed into our meeting because she couldn't be there live and just kind of told us about why she couldn't be there live. And she told us that there were 240,000 orphans in Ukraine, right? So all this news you're hearing about Ukraine, who thought of that? Who thought of there's 200,000 plus orphans in Ukraine? And within a week of the war breaking out, over 10,000 orphans were missing. Many thought to have gone to trafficking. So we went out and said, we'll match any fundraising activities. Anybody wants to commit money, no plan behind it, not thinking it was going to be a big deal. And we ended up raising over $300,000 within an hour or two. And we raised money, and they were able to buy buses and vans and a lot of things needed to get these kids out. And they've now been able to rescue over 1,600 orphans and some refugees in the last few weeks alone. And it was a really cool organization to be a part of. It's called Aerial Recovery. Happy to send that information out to anybody looking for a direct way to impact this crisis. All right, so I'm going to jump into the funds and then turn it to questions. So I'm going to cover these pretty quickly, and then we'll gladly send out more information. You can all be accessed, of course, on the White Coat site as well. So we have 5 funds that are available today to help simplify what we do when I cover these funds. We develop and we construct new affordable workforce housing communities. We do that in a fund called the DLP Building Community Fund. So if you're interested in the development of new housing, that's the DLP Building Community Fund. We acquire and manage existing communities. We do that in the DLP Housing Fund. And then we lend money to other developers and operators across 3 different funds: the Preferred Credit Fund, the Lending Fund, and the Positive Note Fund. This is where we invest, largely throughout the Sun Belt region. All of our funds are impact funds. They're all investing primarily in workforce housing. They are all evergreen, open-ended funds, meaning there's not a wind down period. We're going to keep running these funds for many years to come, we expect, but you as investors have liquidity. You're not locked in to be in the fund forever, but we're never forced to have to sell or wind down the fund at the wrong time. All of them, we believe, are targeted to provide what we believe to be significantly above market return, especially over these last number of months. And they all pay preferred returns out before we earn any fees whatsoever. So the first one is the Building Community Fund. This is the fund building new housing, new communities, mainly in Florida and Texas today. These are equity investments. We're building in this fund right now around 4,000 new single and multifamily homes in communities. The fund's targeted to generate over a 13% return net to investors with an 8% preferred return. This is our only fund, though, that doesn't have the option of taking monthly distributions. It provides annual distributions. So if income is your biggest priority, this wouldn't be the fund. If generating the highest returns, this would be a fund you'd want to look at, and being very tax advantageous. Next is the Housing Fund. This is probably the easiest fund for me to get you to be interested in, and you'll see why here. So last year, we generated 45.57% annualized net returns to investors last year. That is not the return target. The return target is 12%. So to say we exceeded that would be an understatement last year. Not telling you to expect that here this year. The fund's now at about 30%, hair under 30% since we started the fund, and is doing really, really well. And it's a fund today that owns around 12,000 rental homes. It's an equity fund. And maybe the coolest thing of all, of generating a 45% return last year, is from a taxable standpoint, our investors had a net tax loss. 45% return with a net tax loss. So here's the targets of the fund: monthly distribution option, 12% targets. We've generated, significantly higher than that to date. Then we have our lending funds, the Preferred Credit Fund, which is our newest fund. This fund makes both first position mortgages backed by real estate, but also will do some subordinate lending, but only when there's significant equity invested, only to the very best sponsors and operators. This allows us to provide more flexible capital to the very best developers and operators, and in turn, be able to generate a little bit higher returns. So the target of this fund is 10%. We expect, the fund's only been open about 7 months now. We expect returns are going to be ticking up here and will be a good distance above 10% as it's now starting to pick up size and scale. You can take monthly distributions here of the highest preferred return of any of our funds, 9%. That can be paid out to you every single month on the first of the month, or you can reinvest them if you choose. And then you can redeem out of this fund with just 90 days notice. From a practical standpoint, even faster. Then you have our lending fund, our longest standing fund. We're running this fund 8 years, all first position mortgages. This fund has slightly lower return targets, 8% preferred return, 9% target return, but we've never generated less than 10% returns, 13% since we opened the fund, nearly 13% last month. Here's the returns month by month by month. And you'll see what I'm talking about here last month. These are annualized returns, 12.89%. That was the highest return since 2018. So pretty excited about that. Then we have, last but not least, our positive note fund. This is the only fund that you're not investing as a limited partner. You're actually a lender to the fund, getting a fixed return on your investment. In theory and arguably in practicality, this is the lowest risk fund of any of our funds, as you're getting a guaranteed fixed return from us, not guaranteed by the FDIC, but guaranteed by DLP. And you're going to get a fixed return, 5 to 7.5%, based on how long you choose to invest, 1 year, 3 years, or 5 years, and then based on how much you choose to invest. You get 5 to 7.5% return fixed. You can take monthly distributions or let it reinvest, your choice. And this gives you an overview. We can send this out to anybody. It's on the link that on the White Coat site as well, where you can see an overview and a comparison of all the funds, how they stack up. And then, of course, that's where we'd love to talk with you individually and help you decide which of the funds, if any, or maybe multiple, are fit for you. And last but not least, I want to mention one of the cool things we do. I know, Jim, a lot of your group, have the great blessing of having income that exceeds their living expenses. And for those who are in that case, what we find is they let their income build up, or I should say they let their cash in their bank account build up, and then they contact us every 3 months or 6 months, say, "Hey, I got $100,000. I want to now invest it with you," and that's great, and we love when they do that. But you let it sit in a bank account earning nothing for 3 months or 6 months. So what we've done for a lot of our investors really like is we can set up an auto ACH where that money automatically we pull every quarter typically. So that money's getting invested faster and it's not sitting, not earning anything for long periods of time. And it kind of puts growing your investment on sort of autopilot. And we can show you some quick math to show you how you invest in a simple kind of model here. You'll 4x your investment with us within 10 years or less. It's kind of cool to think about, and it's practical as well, which is kind of cool. So, so to wrap up, this is how we did in Q1. A lot of activity, exceeded our return targets as always. Had our best quarter ever in terms of loan origination, a lot of acquisitions, a lot of new capital coming in. Thank you. And last but not least, I want to mention more about the Prosperity membership I talked about. It's a free benefit to you up here. This is our membership we do for real estate developers. And we'd welcome you to join us virtually or live to our upcoming events. We have in Asheville and Bethlehem where you can join us virtually. The link to all of our events is here. And then our big event coming up is in San Juan, Puerto Rico, where it's going to be all focused on longevity, health, and wellness. People think I'm joking or laugh when I say I plan to live to 150. If you come to this event, by the end of the event, you won't think that that's a joke anymore. We're going to have literally the world's experts in health and wellness and longevity at this event. All the guys from, not all the guys, but most of the guys from Tony Robbins' book, Life Force, will be there. The top world-renowned doctors, guys like Dr. G, who's a Nobel Prize winning, who runs the largest stem cell clinic in the world. Dr. David Sinclair, who runs the Harvard Longevity Clinic, wrote the book Health Span. A lot of really amazing speakers. So with that said, of course, you can go to the link on White Coat. Here's our contact info as well, which we, of course, I think is on the main page. All the different team members who are happy to chat with anybody. And with that said, Jim, I'll stop the screen and turn it to questions.
All right. Got a whole long list of questions, and we've been working with you for a long time, Don. And so I've gotten lots of questions about DLP over months and years. And so we're going to go over most of those today. Let's start talking about risk. Risk is a big deal in investing. I mean, much more important than chasing returns is managing risk. And the nastiest event that's happened in real estate in our lifetimes is the 2008 meltdown. it was obviously a different macro environment than what we're dealing with here. But can you tell us a little bit about what you and your team were doing in 2008 and how that affected how you manage your funds today?
Yeah, thank you, Jim. So in 2008, what we were doing a lot of was buying real estate. We believed as things were going south and in terms of values and pricing, that it was a phenomenal amount of distress, which was not good for the average person. We understand, but from an investment standpoint, there were so many opportunities available. So we were aggressively buying and building a portfolio during that time, and strategies, that, like you said, the macro environment, some things were different then, and things that made sense might not work the same way today, which we could certainly get into the nuance. But we were buying and building a business, and through that time of 2007, 8, 9, 10, we grew our revenue every single year during that time by over 60%. So we continued steady, consistent growth, finding opportunities, being able to manage through, as you started this point, risk. And I think the other just point I'll make on that I think is really important to consider, people to think about. Back then in 2006, we had the greatest oversupply of housing in history, or at least recorded history. Today, we have the greatest undersupply. So as you said, very different macro events. But even then, with the greatest oversupply in housing ever, rents in most markets for workforce housing stayed flat or went up. We're in a great undersupply today, but still, even in that time, rent stayed flat or went up, and occupancies went up. So the ability, even in that time, to continue to generate cash flow was there. And so that's why we invest in this strategy. We believe even if property values drop by 50% tomorrow, A, that becomes a great time to buy, but B, our incomes, our cash flow is going to remain very strong.
What keeps you up at night? What are you worried about? What are your biggest concerns with the real estate industry?
So the truthful answer there is my 8-month-old's been keeping me up quite a bit. I was up 4 times last night. So if I look a little tired, that's why. That's the real true answer there. Outside of my 8-month-old, and I feel bad for those who struggle with. I know that's not the actual question, but struggle with sleep problems. I wear an Aurora ring and a Fitbit. And I fall asleep. My latency is 1 minute. Really 1 minute. So nothing actually keeps me up at night. I'm out when my head hits that pillow. And in seriousness, though, because I can rest easy, knowing we're building a great business, knowing we're paying attention, knowing when there is turbulence, I'm confident we've built an organization with people who are going to be ready for it. We're going to adjust. We're going to find opportunity. And we're going to do what we did when things were volatile back in March of 2020, right? We're going to over communicate to investors. We're going to share what's going on. And we believe, investors will make that decision, but we believe when there's crazy times and whatnot, that investors are going to choose to actually want to put more money with us and bet on us being the right manager who's going to be able to weather through it. And that's what happened in Q2 of 2020. We had our greatest inflow of capital ever in that quarter until the next quarter, but meaning people felt confident because of the way we handled the volatility and because of how we communicated how we were handling it, that they continued to put faith and trust in us. And we had almost no redemptions, meaning people wanting their money out, even though we give great redemption flexibility.
Tell us a little bit about your risk management process, both at the fund level as well as when doing underwriting on individual properties and notes.
Yeah, so we could go for a long time here about risk. So I'll start with the first way we mitigate risk is, I heard this saying the other day. It's sort of relevant. Somebody said, am I doing things the right way, or am I doing the right things, right? And so it first starts off with we're investing in the right asset class in the right places that we believe are going to do well in recessionary and difficult times, right? So it first starts fundamentally with what we're invested in, and then it comes down to how we mitigate risk within that asset class. So first I'll say I'm extremely active, as is our CFO, our head of development, our head of construction, our head of portfolio management, our head of management. All of our top leaders are all a part of an investment committee, all part of a credit committee that meets every single week and usually multiple times a week, evaluating opportunities. We have a large team of analysts and associates who are evaluating incoming opportunities using lots of different data sources, using lots of insights and perspective. Our own data we're cultivating through the thousands and thousands of opportunities we look at every day, doing full, thorough underwriting on local markets, on borrowers, on sponsors, on incoming supply, on new development, on construction, on rent growth, on employers, on all the various factors. Lots of components that go into it. That go into evaluating risk at an asset level, risk at a market level, risk at a strategy level, risk at a borrower or a sponsor level. So we've got a large team that does that. We fully document, build out very detailed underwriting, make very conservative assumptions to what's going to happen, which is where it often starts, right? Any deal can look like it makes sense in Excel if you just assume really great things are going to happen, right? If you just assume rents are going to go up 10% a year every year, deal probably looks pretty good, right? If you just assume that cap rates are going to stay at 4%, deal probably looks pretty good, right? But when you stress test what's going to happen if cap rates soften quite a bit. So we stress test what's going to happen in cap rates. We assume cap rates are going to be 150 to 200 basis points softer or higher than they are today when it comes time to sell. We assume, generally speaking, that rent growth is going to be between 2 to 3% annually in most of the markets we're in, even though last year, as I said earlier, it went up 19%, right? We're going to assume that we're going to have 6, 7, 8% vacancy and we're going to have bad debt. Not everybody's going to pay the rent, right? We're going to assume those things are going to happen. And even though our occupancies are actually higher than that, right? So we're real about what we're doing. And then the great value that allows us to be real about what's going on in the market and stress test things and be conservative is having great deal volume, right? When you have lots of options and lots of opportunities to invest in, it makes it a lot easier to make sure you're choosing the best opportunities. So we've got a large team of about 25 people in the front line out bringing in developer and builder and sponsor relationships, bringing in direct deal opportunities. We've built a great reputation in the broker community. So we have heavy deal volume. We have somewhere between 1,000 to 2,000 deals, that come into us every month, and we close, 50, 60, 70 of them. So it takes a lot of effort, a lot of people, a lot of resources, right? I talk to other sponsors or syndicators, and they say, you have, 10 analysts looking at deals. I have one. Why do you have so many people? Well, because we're looking at a lot of stuff, right? Or people say, you have 25 full-time accountants, right? Why do you have 25 accountants? Right? I was talking to a sponsor almost our size and assets who has 1.5 accountants. We have 25. Well, it takes a lot of work to really run and manage the books well and manage the finances and make sure we're protecting ourselves and we're seeing the trends and we're analyzing them and we're producing the analytics and we're producing variance reports and everything, right? This stuff takes people. It takes time. We're constantly working to use technology to help there in analytics, but it takes people. It takes effort. So those are some of the things we do. We can spend a lot more. I'm happy to dig down any path deeper on that, but those are some of the components to how we mitigate risk and how we evaluate risk.
Okay. Now, any investment partnership is a match. It's about matching the manager with the investor. Who is your ideal investor? Who should invest with you and who should not?
It's a great question. So we define our core investor as a wealth creator with a desire to invest in real estate for the long term. So we're looking for those who are aligned with us from a value standpoint. Those who understand. We find the more people have gone through the hard work of creating wealth or of running a business, right, the more they appreciate and understand the way we run our organization, the way we approach and protect investors' capital. And we are very relationship focused. So our 2,100 investors, we work with them all directly. We don't have any broker dealers. We don't have any intermediaries. These are direct relationships. I bet you 1,300 of them, 1,400 of them, I've talked to personally. Probably 1,000 of them I've met personally. And we have almost zero redemptions every year, meaning investors that leave us. I'm 37 years old today, as I just said, only half joking, not even half joking. I plan to live to 150, so I'm closing in on a quarter of the way there. So I've got many years to go, and that's how we think about our relationships. We're not transactionally focused, but we don't take money into individual deals. We don't want an investor for a deal or for a year. We want to build relationships with families, and we want to be a trusted resource, trusted relationship. for many, many, many years. And that's really what we focus on. You may be able to find another fund manager who promises or expects, or maybe even who does generate higher returns than we will generate this year, right? Maybe they'll take more risk than we'll take today, or right? Maybe they just bought a better deal than our average deal. That's possible, right? That's not our focus. Isn't, even though our return track record has been pretty great and pretty spotless in terms of not missing targets. We're focused more on not missing targets, not losing money, than we are on doing what we were able to do last year, thanks to the hard work we did and to an incredible market of 45% last year in our housing fund, right? We're focused on long term, right? So I'm not going to investors and saying, "Hey, we generated 45% last year. This is the time to invest. This is what we can do. We're going to do that this year." What I spent so much time trying to do, and to be transparent, Bob, my CFO, and I had many conversations saying, like, how do we get this returns to be more conservative? Like, how do we keep these values down? Like, because we just don't want people to expect that that's going to continue. Right? We want to be conservative with what the real estate was worth, and because we don't want people coming to us thinking that's the norm, right? Thinking that that's the expectation. We're telling investors, yes, we did that last year, but expect 10 to 12 this year. Will we exceed that? Probably. We've done it every period, right? But that's what you expect when you invest. I want you to be happy if I get you 12% returns, right? Be thrilled if we get you 15 or 20, and jump up and down if we have another year of 45%. But don't come in with that being the expectation, because that's not what we're shooting for. We're not going to make decisions. We're not going to lever up to a point to hit that kind of return. We're gonna run a business model that's going to be able to generate teen return, 12% return. So that's what I would say. In terms of what type of people we're looking for, people who that resonates with, and appreciate that long-term relationship focused approach to relationship with an investment manager or a fund manager.
All right, I'm going to put you on the spot a little bit with the biggest complaint I get about DLP. And the biggest complaints are about the investment minimums. Now, you showed some slides earlier in the presentation that showed the funds had $500,000 investment minimums. Now, I know you've decreased that for white coat investors to a $200,000 minimum. I still have people asking for lower minimums. Tell us why the investment minimum is $200,000 and not $20,000.
Yeah, thank you, Jim. And I will just clarify, the positive note fund, the last fund I wrapped up with, which is the fixed return, does have $100,000 minimum. So we do have a fund that has a lower than $200,000. And you're absolutely right. Those slides that we showed, we didn't customize those slides to this white coat group. Those are what we showed everybody else, right? So to your point, to white coat, we've lowered it to $200,000. To everybody else, when they ask the question, it's $500,000. And the reason for it is fairly straightforward, which is, it takes a lot of time, effort, and work to provide the level of service to our investors that we do. And as I covered a few slides earlier, we just added 8 new team members to this investor relations team, doubling kind of that size. And maybe at some point we'll make the decision, say, hey, we can handle having 10,000 investors, right? But we added 600 last year. Right? That's a lot of new relationships to manage and support. And many of them are invested in multiple funds with us, and then bring in multiple family members and trusts and IRAs and individual accounts. And it's just a lot. And the last thing I tell this to my team members, and we tell this to other, developers thinking or running funds. It's even more important, arguably, than the returns you generate, than the communication and the reporting and the tax returns and all the communication of what's going on happening, right? I could generate 50% returns, but the distributions don't come on time. The reporting doesn't come on time. But fundamentally, I'm doing a great job, and you're going to be nervous and upset, right? So delivering that level of consistency, and not just the returns, but the communication and the tax side and the reporting, we have human resource, limits. And then the last piece to it is in full transparency. Out of everything I get to do as CEO of this organization, and I get my hands in a lot of the organization, and I love everything I get to do. But the thing that I enjoy most of all is building relationships with our investors, is knowing we're a part of not only what they're doing in their lives, their kids, grandkids, the ministries they support, the communities they're involved in. And for not just me, but for a lot of us, to build those deep relationships and not be transactional is really, really important to us. So I'd rather add 100 investors that we can build deep relationships and be a meaningful part of their life and their investments and their future, right? Than bring 1,000 investors in who are just another line item on their balance sheet and having no major impact other than some good returns. So that's the approach we've taken to our growth. And as we grow as an organization and our resources grow, we'll continue to evaluate that.
Now, investors have lots of options when it comes to real estate investing. One of the easiest, minimal investment minimums, lots of liquidity, lots of diversification, is simply to invest in the public real estate markets, to buy a REIT index fund at Vanguard, et cetera. Why should someone invest with you instead of going to Vanguard and buying a REIT index fund?
So I'd say a couple reasons. So one is, the public REITs are who guys like I sell properties to, right? Because they buy at top prices, right? Because they have to do, right? They're deploying large amounts of money without the kind of in-depth boots on the ground ability and relationships. They can't do the heavy value lift. They want to buy things that are already performing really well. Already the hard work's been done, right? So they're great. I love the public REITs. We sell to them regularly because they'll pay more than everybody else. So fundamentally, I always believe what's important more than anything else, right? A property could be a great investment at one price and a terrible investment at another price, right? The same piece of real estate, right? So price is important. I think people overlook that in a rising market. Your basis to what you paid is what trumps everything else. So I don't know any public REITs who are able to buy at the kind of basis we buy at and can handle the value creation that it takes, the boots on the ground, the actual construction and development teams and management teams and so forth to do. So that'd be one. Second, I would say is costs. So for these public REITs, roughly 10% of the capital invested into a public REIT gets spent annually on costs related with capital raising, related with compliance, related to administration. There's so much extra costs that come about that we don't have, right? We've never paid $1 for capital raising, right? Funds have never paid $1, right? We don't pay for capital raising. We don't have the heavy burden of compliance administration. And then third thing I'd say is we have the flexibility and freedom to do what makes the best sense to do. For the long term, to hit our overall targets, we're not driven by what do we need to do to report to investors tomorrow or next week, or we're not having to manufacture or make decisions that are short-sighted just because we have to hit our earnings number. So I think we're able to be fundamentally driven by what makes the best sense, not what makes the best sense to economists or analysts, which makes a very significant difference, especially when things are volatile. So those would be a few of the reasons that I would say investing in a private fund manager such as DLP, something you'd really want to look at versus a public REIT option.
Okay, so let's ask you a similar question. Why would an investor choose to invest with you instead of some of your other competitors in the private real estate fund space? What do you see as your biggest advantages?
And there's a lot of them out there, and there's some really good ones out there for sure. I would just say, so let's say there's 100 guys out there, gals who are fund managers who run multifamily funds, right? Like our housing fund, right? I bet you if you searched hard enough, you could find 100 different fund managers out there that do something similar to what we do, right? So what I would say and why you would choose DLP versus the other options, first and foremost, above everything else, is who do you think is going to execute the best, right? Managing multifamily real estate is not easy, right? It's not like, these aren't triple net leases, right? There's a lot of hard work that happens. It's heavy management. It takes execution, right? So I believe management matters. There's two things that matter in investment. I always think about strategy and it's management, right? So if you chose that you're going to invest in the strategy of multifamily real estate, who's going to execute the best? Who's the best management team? Who you're confident not only has the best team and the best resources, but who do you think has the best judgment? Who's going to make the best decisions when things are tough, right? Who do you want navigating your money through volatile times? That would be the biggest thing I tell you to think about. Decide, am I that person, or is my man? It's not just me, of course, but I as the leader. Are we the best management team, or can you find another team that you think is a better manager, going to make better decisions, is going to take care of your money more effectively, has more resources than we do, and so that'd be the first thing I'd say. And then the second thing I'd say is structure. So the way we structure our funds is evergreen, open-ended funds that give you flexibility and liquidity, while allow us to have the flexibility to make the best decision, not being driven by the timeline of a fund, is really critical and really different than just about every other fund out there. The fact that we pay our investors before we get our pay investors preferred term before we even get a management fee, that's very unique and different. So I think the structure to how we set up our investments and the management team are the two big things that differentiate us from most everybody else out there in the marketplace.
Another thing a lot of people wonder about with DLP is simply because you offer a lot of options. You offer 5 different funds. And I leave it on them to decide whether they want to invest on the debt or the equity side. But let's say somebody wants to invest on the equity side. How should they decide whether to invest in the ground up fund and invest in, ground up projects, or in the housing fund, where you're buying, properties that have already been built? How should an investor decide that?
It's pretty relatively simple in for a lot of people. Not necessarily everybody. There could be more nuance to it. But if you're deciding one or the other, right? And many people, kind of to your point, they don't choose one or the other. They split. But I would say is which option is what's critical to you. So if you need monthly income, right? So if you're looking for tax advantageous investment, that's why you would choose either fund, right? They're both make a lot of sense from a tax standpoint. But if you're looking for monthly or a consistent income, you're going to choose the housing fund. The building community fund only provides annual distributions today. It may later provide more frequent, but right now that all the assets in the fund are in development and construction, we don't have the ability to pay out monthly or even quarterly income today. So if you want monthly income, the housing fund's a choice. If you want to get the highest return, we expect that the building community fund over the horizon is going to outperform the housing fund and generate higher returns. Simply put, because the value creation side on ground up development and construction is greater than the value creation side of buying existing housing. Want highest returns, you go with the building community fund. If you want monthly or consistent distributions, you go with the housing fund.
Same question, but on the debt side. I can't decide between the preferred credit fund and the lending fund. Which one should I invest in?
It's a pretty similar situation. So you'd invest in the preferred credit fund to get the highest returns. So we do expect it's a newer fund, so it doesn't have the track record yet. It's only been open a few months, but we do expect, because of the type of lending we're doing there, that it'll generate 1 or 2% higher returns in the lending fund as a 1% higher preferred return. So you'd invest in that fund for the higher returns. You'd invest in the lending fund for 2 reasons. One, it's bigger. It's got a long track record, right? It's been around 8 years, got a long track record, size. And then 2 is they're all first position mortgages. So if we had the time here to have a deep conversation there, I could easily take the stance, and I don't have really a stance on it. I think that it's two different situations. I don't think one's any more risk than the other, but I could easily make the argument that the preferred credit fund is lower risk than the lending fund. And I could make that argument very, very convincingly because we're only lending to the very top tier operators in the preferred credit fund. There's typically over $1 million of equity behind the fund, often equity pledges behind the fund, larger, better properties. But some people like the fact the lending fund is all first position mortgages, and that's an important risk factor to them.
All right, let's talk a little bit about another complaint that people have in the private real estate space, which is tax reporting, right? People hate getting their K-1s late. As you mentioned this year, all your K-1s were out on time for people to file on time. But tell us what they should expect from each of the funds. What do they get a K-1 for? What will they get a 1099 from? Which of the funds did people have to file taxes in multiple states for this year, et cetera?
Great question. And I'm going to preface my answer to say I think I'm 99% correct in everything I'm about to say. I could be slightly off.
But you're not one of those 25 accountants. Is that what you're saying?
I'm not one of those accountants. So what I can tell you is the DLP Lending Fund provides 1099 statements instead of K-1s. It's a private lending REIT, and that gives us the ability to produce 1099 statements, which go out the end of January instead of March. It simplifies, depending on what other investments and what your tax situation looks like, right? It may simplify your tax package a little bit then. So every other fund is a K1. All of our K1s went out by deadline. I'm pretty sure, but I'm not 100% sure, but I'm pretty sure that we've never, ever been late on our K1s. I think every single year we've got them out on time, which is a massive task because we have to get the tax returns done at each property we own. And some of those tax reporting is done by our partner. So we have to get, right now in the housing fund, I don't know what is 60 different tax returns done and by multiple different people and multiple different tax accountants to get that to roll up into one K1 and get that out on time, right? It's not an easy task, but I believe we've done it in every period. And then I believe that none of our investors have to file tax returns outside of their home state today in any of our open funds. So that's the one that I'm 99% sure, but at least directionally that's the case in most of our funds and for almost all of our investors.
I know that was the case for me for 2021. As you know, I'm invested in the lending fund through a 401k actually, and then in the housing fund in directly in a taxable account. And there were a lot of K1s, a lot of state K1s that came with my DLP K1 this year. It was a 45-page packet or something, but I did not have to file in any other state due to owning the DLP housing fund. So
awesome. And I'm 99% sure
I've only gotten a K1 from DLP once, but that's what happened to me this year anyway.
Awesome.
All right. Well, our time is now running short. I don't want to go, beyond an hour really here. What else have we not talked about today that you think, potential investors in DLP should know?
Yeah, we've covered the gambit here today, Jim. So thank you for that. I would just leave with, we are. I kind of said it in one of the questions you asked about our typical investor, but I just want to reiterate, we are extremely relationship centered. We love and welcome the opportunity to build new relationships. If you haven't reached out to us in the past, we haven't had the privilege of getting to watch something like this gives a great amount of information, but it doesn't replace having a face-to-face or a Zoom or even a phone conversation to talk more specifically about what we do and how that could fit into your goals for your family or your wealth. And we welcome those opportunities. You won't ever find one of our we don't have salespeople. We have investor relationship managers. We call them investor success managers. You won't find an investor success manager at DLP who will ever put any pressure on you or put any push. They focus on providing education and resources, connecting you with other investors. That's one of the cool things now through White Coat is not only can we always put you in touch with other references investors with similar situations to you, we can do that. We can put you in touch with many other White Coat members you can talk to and get their hands-on and real life experiences. And I guess I'll just wrap up then. A perfect example. And some of the White Coat members joined us at our event I mentioned in March. And we do these events where we have this one coming up in San Juan where we'll have hundreds of individuals. By hundreds, I mean, 400, not thousands, but say 400 individuals at this event. Our last one in March, we had about 500. And we have 50 of our DLP employees at that event. We have 100 existing investors who have money with us at the event. We have 50, 100 prospective people who are not yet invested with us. We have 50 of the operators we lend to and partner with at the event. We have 50 of those that we're talking to about partnering and lending to, right? We have probably some people interviewing to come work at DLP who are at the event. We have all these people at the same event, sitting at the same tables, talking with each other, all interconnected. And you can't do those things if you're not who you say you are, if you're not transparent, if you're not honest and open with everybody you're kind of with. You can't let those people all intermingle and be confident that the outcome is going to be positive, right? So I just encourage you, if interested in learning more, reach out to us. We're happy to talk to you. We're happy to put you in touch with others. We're happy to welcome you to any of our events and learn more. We recognize the decision to invest any significant amount of money, which certainly to your point, Jim, earlier, $200,000 is significant to any of us. With a private fund manager such as yourself is a big commitment. And we welcome the opportunity to earn your trust and build a relationship.
Awesome. For those interested in getting more information on investing with DLP, you can get that at whitecoatinvestor.com/DLP. Thanks so much for your attention tonight in this webinar, and hopefully you will have exceptional professional and investment returns going forward. Thanks for your time.
Thank you, everyone.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.